Let's talk about really the only way to protect against market volatility, right? So the market goes down 50%, right? What is the only way that you can really protect yourself? And there really is only one mechanism in place, and it's the same mechanism that insurance companies use, and it just gets repackaged in a whole lot of different ways. And the best analogy that I have for this is when you go to sell your house, right? So for people who trade options, they may understand this. So I'm going to give you an analogy that I use for people who aren't familiar. When you go to sell your house, you go in, someone goes into contract with you or you go into contract to buy a house. And what do? You sign a piece of paper and you give a deposit, right? You sign a piece of paper that says, I'm going to buy this house or I'm going to sell this house by this date. And if I don't sell it by this date for this price, then I'm going to forfeit this amount of money. So essentially, you're paying a sum of money for a contract that gives you the right to buy or sell your house at a specified price at a specified time, right? Well, that doesn't just only apply to real estate. We can do that with stocks. We can do that with bonds. We can do that with almost anything. The term for it in the stock market is called options. We can buy option contracts and we can get fancier and call them calls or puts. And there's lots of variants of them. But essentially what we can do is buy the right to sell the stocks at a certain price, buy the right to buy stocks at a price, or sell someone else the right to buy it at a certain price. Now, why would you do this? Well, let's say I have a $1 million house, right? And I know that I'm worried about the real estate market going down, right? Well, if I think that a real estate crash is imminent, right, I would probably go and sell my house so I can cash out that equity that I've built up over the last 10 years from this crazy market, or the last 5 years, right? Well, in the stock market, I have the ability to have my cake and eat it too. I can sell my house, but only if I want to. So I can go out, find a buyer who will say, listen, you paid me $10,000. And I will buy your house for you sometime within the 90 days, whenever you decide, sometime in the 90 days, the next 90 days for $1 million, right? But you have to pay me $10,000 for the right to do that, right? At any point within the next 90 days, you come to me and I will buy your house from you for $1 million, right? If you could do that, that's a great way to lock in the value of your home.
It is.
You could do the same thing on your portfolio, and that is what the insurance companies do.
So that's what the insurance companies do. But is it really materially different than what an insurance company can do and then what I can do on my own? Or is that why I need a yields for you specialist or someone who does what you do?
Yeah. So we'll get into the different ways of that this gets packaged, but fundamentally, this contract that we're talking about, the right to buy or the right to sell, anyone can do it. The contracts that the insurance companies use and the ones that I really like are very difficult, even for investors like myself, to get access to, and to get access to at prices that are advantageous. Because what you want, right, for anyone who's sold covered call strategies, or anyone who's done naked calls, which has become very popular, or these 0-day options, you can go out and you can buy these things. You can buy these contracts. Robinhood made it very easy for anyone to do it. The problem is when you're dealing with significantly large amounts of money and you're dealing with long time horizons, right? Like, it's great if you want to do it. Yeah, you want to buy a 0-day option and it expires today. Great. You can go on the open market, find what's available, decide if you've got enough profit there and buy it. But what happens when we're talking about something that might happen in 6 months or a year, right? Or 2 years, right? All of a sudden, we're going very far out into the future, right? As we go out further into the future, the uncertainty of the future really starts to play a factor into the cost of these options, and it may get very expensive, right? Because if we're in the thing about selling our house, when we come to someone and we say, I want the right to sell you my house sometime in the next 2 years, I'm not going to tell you when, but when that happens, I want you to pay me $1 million. Well, if you came to me and gave me that deal, I would tell you, I don't know that it's going to be worth $1 million in a year from now. That's a huge risk to me, right? What if the market crash happens tomorrow? right? What if it happens in 6 months and I'm stuck paying you $1 million and I might not be able to sell it for $1 million, right? So the cost for that contract increases, and the people who are willing to take that other side of that deal get smaller and smaller and smaller, which means it becomes harder and harder to find it. Which is why, right, when you're someone like an insurance company, like Allianz or whoever, Athene, right, AIG, or some of these huge corporations, right, Goldman Sachs, Merrill Lynch, right, they're dealing with billions of dollars. Oil companies, by the way, they are very big in this industry and in this business. They have to find counterparties to this, right? They can't just go to the open market, and so they have to find counterparties who are willing to take the other side of that deal. And that's what a lot of their negotiations is well, I want this, you give me, I'm going to give you this, you're going to give me that, and you're going to offset my risks. And they just do this circular thing of offsetting each other's risks, so that they're playing a mostly risk-free game on our money, right? The trick is how do we get to participate in that, so that we can't get the risk-free, not at the rate that they get. Like, if you have a lot of money, there is ways to get access to it, but even still, right, like, you might be able to get access to, X% return, but they're making twice that amount.